The advancement of technology and changing consumer behavior have drastically transformed the way banking is currently done. The rise of neobanks and fintechs has been sparked by these two factors. Customers today expect instant access to financial services and a seamless user experience. People want to be able to open accounts, apply for loans, and make payments on their mobile devices without having to visit a physical branch. The demand for convenience and speed is driving the shift towards digital banking. At the same time, technological advancements have made it possible for startups to enter the market with lower overhead costs than traditional banks. So in this video, we're going to talk about the differences and similarities between fintechs and neobanks. We'll highlight the services each of these tech providers offer, their impact on consumers, and the future outlook. If that sounds interesting to you, then let's chat about it. Hello friends, welcome back to the channel. My name is Jeremy, and if you're new here and haven't yet subscribed, please consider doing so because on this channel I speak about fintech, digital transformation, and agile strategy. So jumping straight into it, let's start by defining, or rather describing, what neobanks are versus what fintechs are. Neobanks are relatively new actors in the banking industry, and unlike traditional banks, they don't have physical branches or established legacy systems. Neobanks are also known as digital banks or challenger banks, and instead of physical brick-and-mortar bank offices, neobanks allow the users to access their accounts using user-friendly mobile applications and internet portals. Neobanks offer a full suite of banking services including checking and savings accounts, loans, and payment solutions. Because of the absence of the costly overheads that come with maintaining physical locations, neobanks are able to prioritize user experience and offer competitive pricing, making them more attractive to consumers and small businesses looking for convenience and to save money. Popular examples of neobanks are Revolut and Monzo in the UK, Chime in the US, Time Bank, and Kuda Bank in Africa. Fintechs, on the other hand, encompass a broader category of firms that use technology to enhance or automate financial services. Fintech is short for financial technology companies, and unlike neobanks, fintechs specialize in specific niches that can operate in various segments of the financial industry exclusively, from payments and lending to wealth management, FX and crypto trading, and insurance. Fintechs typically employ a partnership-based model and work with banks and established financial institutions to enhance their offerings or develop new financial solutions, whilst helping them integrate technology into their offerings to meet the needs of the new generation of consumers who want services and information with a click or a swipe. Popular examples of fintechs are Stripe, PayPal, Wise, TripperCash, and Jumo. Now, it's easy to confuse fintechs and neobanks because both operate in the digital finance space and often share overlapping features. Many neobanks are frequently categorized as fintechs and vice versa because both utilize technology to innovate and improve financial services. This confusion comes from the fact that neobanks are, in essence, a subset of the broader fintech category, while fintechs encompass a wide range of financial services ranging from payments and blending to wealth management and insurance. Neobanks specifically focus on providing traditional banking services through entirely digital platforms. The lines blur further because many fintechs, particularly those offering payment solutions or lending services, sometimes expand into banking services, and neobanks often incorporate fintech innovations like AI-driven financial insights or blockchain technology into their platforms. So the similarities definitively are: 1, digital-first approaches. Both fintechs and neobanks prioritize a digital-first model, delivering their services through mobile apps and online platforms. Second is their customer centricity. Both neobanks and fintechs focus on enhancing the customer experience, offering user-friendly interfaces, personalized services, and often lower fees compared to traditional financial institutions. Thirdly is innovation and technology. Both of them leverage advanced technologies like AI, big data, and blockchain to provide cutting-edge financial solutions to serve the new age consumer. Now, when it comes to the differences, they can be observed in: 1, the scope of services. Neobanks primarily focus on core banking services such as savings and checking accounts, loans, and payment processing, while fintechs, on the other hand, cover a broader spectrum, including services like investment management or insurance, insurtech, and payment gateways. Another difference is in their regulatory status. Neobanks often have full banking licenses, allowing them to operate as fully fledged banks. Fintechs may not have such licenses and typically partner with traditional bank or financial institutions to leverage their licenses in order to offer their services. And the third difference is in their business models. Neobanks generally generate revenue through banking services like interest on loans, interchange fees, and subscription models. Fintechs, however, have more diverse revenue streams, including transaction fees, advisory fees, revenue sharing with partner banks, software as a service or platform as a service models for financial service providers whenever they offer their tech platforms. Now, the rise of neobanks and fintechs has a profound impact on consumers like you and I, and there are several significant benefits that are reshaping the way people manage their money and finances. Here are some reasons why the proliferations of neobanks and fintechs matter. Number one is enhanced accessibility and convenience. Neobanks and fintechs provide financial services that are more accessible than traditional banks, especially for those who may have been underserved by conventional banking systems. With just a smartphone and an internet connection, you can now open accounts, transfer money, apply for loans, and invest without needing a physical branch. This convenience is particularly beneficial for people living in remote areas or those with very busy lifestyles. Secondly, lower costs and fees. By operating digitally and cutting out the overhead associated with physical branches, neobanks and fintechs can offer services at a lower cost. Consumers often benefit from reduced fees, higher interest rates on savings, and more transparent pricing structures. For example, many neobanks provide fee-free accounts, no-cost overdrafts, or free international transfers, making banking more affordable. Next is personalized financial services. Neobanks and fintechs use data-driven insights to offer personalized financial services. Through advanced algorithms and artificial intelligence, these platforms can analyze consumer behavior to provide tailored recommendations, spending insights, and budgeting tools. Also, there's increased competition and choice. The entry of neobanks and fintechs into the financial industry has increased competition, pushing traditional banks to improve their services and adopt more customer-friendly practices. This competition benefits consumers by offering more choices, better products, and improved customer service. It also drives the financial industry to evolve, ensuring that consumers have access to the most up-to-date and efficient financial services. So the future looks bright for both neobanks and fintechs as they continue to disrupt and redefine the financial services industry. Collaboration and competition with traditional banks are likely to intensify, leading to further innovation and improved financial services for consumers. Regulatory frameworks will also accommodate these new entities, ensuring stability whilst also fostering growth. Neobanks and fintechs are well positioned to capitalize on emerging trends such as open banking, decentralized finance, and the increased adoption of digital currencies and AI. As consumer preferences continue to shift towards digital solutions, these tech-driven platforms will play a crucial role in shaping the future of banking, making financial services more inclusive, efficient, and accessible for all. The distinction between neobanks and fintechs may blur over time as both continue to expand their offerings and adapt to the changing financial landscape. However, their shared commitment to leveraging technology for better financial services ensures that they will remain at the forefront of this industry's evolution. I hope you found this video valuable, and if you did, remember to hit the like button and leave me a comment. Have an amazing week, and I'll see you in the next video. Cheers, guys.